Have you ever felt like your CPF ordinary account is growing way too slowly? Maybe you've been told that the 2.5% interest rate is safe and steady, but deep down, you worry it's just not enough to keep up with rising costs. What if I told you there's a smarter way to make your CPF work harder for you, without taking reckless risks? Today, I'm going to share the CPF OA Playbook for 2025, breaking it down into 7 key points that will change how you think about growing your retirement savings right here in Singapore. I'm Iggy from the Investing Iguana. I've been covering stocks, finance, CPF, and everything about building wealth in Singapore for years. Our channel is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 1 million reads and 58,000 likes. I've produced more than 900 videos with over 500,000 watch hours as of June 2025. I also keep a close eye on regional and global economic trends. If you're serious about taking your Singapore investment journey to the next level, this video is for you. Here's what we'll cover today: why leaving your CPF OA at 2.5% is riskier than you think, how to use CPF investment scheme rules to your advantage, the 5 Singapore stocks and REITs that stand out in 2025, how to build a resilient CPF OA portfolio, the biggest risks and how to manage them, what your CPF OA could look like in 10 years with the right strategy. And finally, my personal take and actionable advice for every Singaporean investor. Let's get started. First, why is leaving your CPF ordinary account at 2.5% actually risky? The problem is inflation. In Singapore, inflation often runs between 3 and 4%. That means your money is losing value every year, even though it's earning interest. Imagine saving diligently for years, only to find that your money buys less and less when you retire. Over 10 or 20 years, this slow erosion can seriously hurt your retirement plans. Now, the CPF investment scheme, or CPFIS, lets you invest up to 35% of your OA funds in mainboard listed stocks and up to 10% in REITs. This isn't about gambling your retirement away. It's about using a portion of your CPF to tap into higher returns while keeping most of your funds safe. Think of it like upgrading your kopi from the usual to a stronger brew. Just a little more kick, but still familiar and comforting. So, which stocks and REITs should you consider? After reviewing the latest data as of July 8, 2025, here are 5 picks that offer the best mix of yield, growth, and resilience for CPF OA investors this year. First, DBS Group. It's the digital banking leader in Singapore, with a return on equity of 18.3% and a dividend yield of 6.8%. DBS trades at about 11.25 times earnings and has a strong capital position, giving it room for special dividends. Its digital transformation and growing fee income support long-term profit growth. Next, United Overseas Bank, or UOB. It trades at around 10.3 times earnings and offers a 5.18% dividend yield. UOB's focus on ASEAN markets and the integration of Citi's consumer banking assets have boosted its fee income. With a strong capital ratio, it's well positioned for future dividend growth. Third is OCBC Bank, the value pick among Singapore banks. It trades at about 9.94 times earnings and 1.2 times book value. OCBC's 93.7% stake in Great Eastern Holdings offers a potential value unlock for shareholders. The bank maintains a conservative dividend payout and has a strong domestic and regional presence. Fourth, ST Engineering. This company benefits from global defense spending and smart city contracts. Its market cap is about 25.6 billion Singapore dollars. The stock trades at a premium, around 34.8 times earnings, but its strong order book and government backing provide earnings visibility. Its focus on high-tech and digital solutions supports long-term growth. Finally, Mapletree Logistics Trust. It offers a 6.9% dividend yield and exposure to Asia's growing logistics sector. With a portfolio of 180 properties across 9 countries, it provides diversification. The REIT trades at about 0.8 times book value and maintains high occupancy rates above 95%. As interest rates decline, it stands to benefit from lower financing costs and continued e-commerce growth. Now, you might be wondering how to put this all together into a portfolio. The key is diversification and discipline. Here's a sample allocation that balances growth and safety: 20% in DBS Group, 15% in UOB, 15% in OCBC, 15% in ST Engineering, 10% in Mapletree Logistics Trust, 10% as a cash buffer, and 15% kept in your CPF OA for flexibility and opportunistic investments. This keeps you within CPFIS limits and ensures you're not putting all your eggs in one basket. Think of it like building a Hawker Center plate. Some rice, some meat, some veggies, and a little bit of everything for a balanced meal. Of course, every investment comes with risks. Interest rate changes can affect bank earnings, economic slowdowns can impact credit quality, regulatory changes can shift the landscape, and concentration risk means you shouldn't overcommit to any one stock. If the market drops, ask yourself if you'll panic and sell. If yes, keep a bigger cash buffer. If you're comfortable riding out eeps and downs, you can allocate more to stocks and REITs. Let's talk numbers. If you leave 100,000 Singapore dollars in your CPF OA at 2.5%, after 10 years, you'll have about $128,000. But with a diversified CPFIS portfolio, you could see much more. A conservative scenario with a 5.5% annual return grows your money to $168,000. A base case at 7% return reaches $197,000. And an optimistic 8.5% return could grow your portfolio to $227,000. That's the power of compounding. Small differences in returns add up to big differences in your retirement nest egg. If you want to see the full tables, detailed charts, and a written breakdown of everything we've discussed today, check out the Investing Iguana Substack. The link is in the description. There, you'll find even more facts, figures, and insights to help you make smarter decisions with your CPF. Getting started with CPFIS is straightforward. Open a CPF investment account through an approved agent bank, assess your risk tolerance and investment horizon, start with a small allocation of 10 to 15%, and scale up as you gain confidence. Review and rebalance your portfolio annually or when market conditions change. Keep an eye on dividend sustainability, market valuations, and sector trends. Rotate your holdings if needed, and always stay within CPFIS limits. Here's my personal take. The CPF OA is a powerful tool, but only if you use it wisely. Too many Singaporeans leave their money idle, hoping that 2.5% will be enough. But with inflation and rising costs, that's just not realistic anymore. My advice is to start small, stay disciplined, and focus on quality. Don't chase the latest fads or try to time the market. Instead, build a portfolio of strong dividend-paying stocks and REITs that can weather the ups and downs. Keep a cash buffer for flexibility and review your plan every year. From my years covering the Singapore market, I've seen that those who succeed are the ones who take action early, stay patient, and keep learning. Your CPF is your future. Make it work for you, not against you. So, we've broken down the CPF OA playbook for 2025, and I've given you my personal take on how it applies to your journey here in Singapore. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get my detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of kopi. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. Thanks for watching, and I'll see you in the next one.